Hello, welcome. I'm Dr. Palumbo, and in today's short video we're going to discuss bonds payable. Now, I can already hear the moaning and groaning because this is one of those chapters that students just don't like. But hopefully we'll be able to clear that up a little bit for you, and you'll feel a lot better after this video. Let's keep our fingers crossed anyway. Alright, so there's lots of terminology in bonds payable. I'm not going to go through that. You've got your textbook for that. You can look up those terms anywhere online, so I'm not going to worry about terminology. I want to talk about discounts and premiums because that's an area that most students have issues with. Now, if I just issue a bond, I debit cash and I credit bonds payable for the amount. And we're going to use a simple example today of just a $1,000 bond. When these corporations or municipalities or federal government do this, they do it in the tens or hundreds of millions of dollars, but we're just going to keep life simple, and a basic bond is $1,000 face value, and that's what we're going to go with today for our example. So what happens is, if I had a bond, if I issue a $1,000 bond, it's a simple enough item: debit cash, credit, bond payable, the liability. After 10, 20, 30, 40 years, I think they're going out to about 100 years now, some of these bonds, I pay it off, I debit bonds payable, I credit cash, and we're done. But things change. And also you need to go back and remember our interest. It's principal times rate times time. That's the computation we're going to be using here in this video. So let's say I have a $1,000 bond, and I'm going to use an 8% rate, although today, who knows, but for illustration, it's a nice fat round number to work with. And then time, because this here is the annual rate. Okay. That's an annual rate now, and I would have to pay you 1,000 times 8% or $80 a year in interest. But bonds generally pay interest semi-annually, so I would say, okay, this is for a half a year. My semi-annual payment would only be $40, and I do that twice a year. Any two dates 6 months apart would work. It could be June 30th and December 31st, or July 1st and January 1st, it doesn't matter. Now, what happens is, if I sell this bond, I shouldn't say sell, issue the bond is a better term, at its face value, and you should know that term already, of $1,000, I'm going to get $1,000, and then everything is real easy. But what happens is, in between the time that we make a decision to go ahead and do our financing through bonds, and we actually issue these bonds, interest rates are going up and down. So what happens is, here we have principal times rate times time. That rate was a stated rate that's printed on a bond. I've guaranteed to pay you your $1,000 principal and that 8% rate. That's printed on the bond, and I'll also tell you the dates I'm going to pay you. But let's say interest rates go up, okay? Because if I take my $80 I'm going to get, and I divide it by what I gave you, I'm the investor now, that's a sloppy 8, that's an 8% return. But what if I didn't want 8%? What if I said, hey, wait a minute, these bonds, they're not keeping pace with the market. The market rate of interest has gone up, but if you want my money, you got to give me a better rate. Well, this is already printed on the bond, the $1,000 and the 8%. I cannot change those, not without going back, going through board approval or having the bonds reissued, re-engraved. And by the time all that happens, interest rates are going to change again. So the only thing I can do is adjust the issuance price. So let's say I drop that down to, I said, no way, I'm going to only pay you $800. Now I'm getting a 10% return on my money. And by the way, we're just using some simple computations. I'll explain a little bit later about the present value computations. So we're just going to keep it simple. If this was a graduate finance class, we'd be talking a little bit different than a introductory accounting course. So what I've done then is I'm only going to be able to issue that bond for $800. That's all the investor's going to give me. So now what? I've got an obligation to pay you $1,000. That's what I told you I was going to do. You only gave me $800. Now what? What we're going to find out then, I'm going to pay you out $1,000. You gave me $800. What do I do with this extra $200? It's an additional cost of borrowing. Because you're going to give me $800, I'm going to give you back $1,000 at the end of whatever the term of this bond is. That $200 ends up being a discount or additional cost of borrowing to the company. Now, when should we report that? Should we report it today when we issue the bond for $800? Should we report it maybe 20 years from now when I pay you the $1,000? Well, you know, as accountants, we're crazy for doing amortizing and spreading things out over useful lives and matching revenue with expenses and all that stuff. So we're going to say, no, this is going to be amortized over the life of the bond. And we'll use maybe a 20-year bond in our next example. Okay? That's one thing. Now, what happens if things go the other way? What if interest rates are coming down? And we just pull this back 1 second, so hopefully we won't rattle on this as much. There we go. What's going to happen if interest rates go down? In our example, they went up from 8 to 10. Well, they're not going to pay me as much. I'm going to ask for more money. I'm not going to accept the $1,000. So I might say, hey, you want that bond, you've got to give me $1,100 because I'm going to give you this rate of 8%. That's way above market, not way above, but above market. So what happens now is I'm still getting that same $80 a year. That doesn't change. Okay? But if I gave you $1,100, that's roughly a 7% rate. I think it's like 7.2 or something like that, but 7% close enough for our argument's sake. Okay? So what we find out then is this with bonds. Okay? We can issue them at par, which equals 100%, which would be 1,000. Okay? Or I could issue them at something greater than par. Okay? So it would be greater than 100. In our case, that would have been 110. 110. And when you see a bond being issued at 110, all it means is you're paying 110%, okay, or $1,100. Or I could issue it at a discount, and I'll say that that bond is being issued at 80, which means, these are in dollars up here, means 80% of the face value. So that's what those terms mean. If I issue it more than that, I'm issuing it at a premium. Anything less than that is a discount. Okay? All right. So hopefully everybody's okay at that point. Discount. By the way, what determines this? When bonds operate in the opposite direction of the interest rates. So when interest rates are going up, bonds are going down. So I'm going to have to issue them at a discount. We saw that. Interest rates went up, so I had to issue it at a discount. When interest rates come down, the value of the bonds go up, and that's what I have over here. Okay. So now let's see what happens with that. Going back to our original example, I have a $1,000 bond. I issued it for $800. I have a $200 discount, which is at this point a contra liability account. It's not a gain, it's not a loss, it's not an expense just yet. It will become an expense, but again, we have to amortize it over the life of our bond. So let's say this was a 20-year bond. What I'm going to do, and let's make life simple, even though we normally pay every 6 months. Let's just say we pay interest once a year in our simple example to keep the numbers a little easier to deal with. Well, and so I've got $200, okay, that's going to be sitting, let's do our journal entry. I'm going to debit cash, 800, that's how much money I'm getting. I'm going to debit that discount, 200, and I'm going to credit bonds payable, 1,000, because that's always, what we can see down here, that's always at the face amount. Okay. We always credit the bond payable for the face amount. Obviously, we have to pay debit cash or the actual amount received, and then the difference will fall in either a discount or a premium. In our case, we have a discount. So that's going to be sitting in this T account. As a debit. What's going to happen is, if that's a 20-year bond and I've got a $200 discount, I'm going to take 200 divided by 20. I'm going to amortize that discount at the rate of $10 per year. So in the first year, I make my interest payment. Okay, I would debit interest expense, $80, right? I would credit cash, $80. All right. Now, what I need to do is, at this point, I need to amortize my discount. Okay. So what I'm going to do is I'm going to say debit interest expense, 10, credit that discount 10, and once I do that, it leaves me with 190 in my discount. Okay, 190 in my discount. So I'm going to continue to do that every year for 20 years. Okay, and at the end of 20 years, what I'm going to find out is that the amount of my discount is 0. Okay, and that's what I want it to be, 0. And I've successfully amortized that. So if I looked at my interest expense, not only do I have the $80 that I paid, but I also have this. So that's how I reflect the additional cost of borrowing over the life of the bond. All right. Now, so everybody's okay up to that point. I want to erase this board. And how I'm going to show that bond, I'm going to show it as, in the balance sheet at face value, 1,000 minus the discount. Discount's not 800, discount's 200. I show it as $800 on my balance sheet at the end of the year. Oh, excuse me, at the time of issue. After 1 year, when I've amortized that discount, my discount has dropped down to 190, and my bond has gone up to 810. Okay? At the end of year number 2, what's going to happen? This will be, what was I doing? $10 a year, right? So this is 180, and my bond goes up to 820. So what's happening is my discount is coming down. I'm amortizing it. The carrying value of my bond is going up. Okay, and what's going to happen at the end of 20 years? We said it was a 20-year bond. At the end of 20 years, there will be no discount. Okay, that's going to be 0. And my bond's going to be at $1,000. Now, the difference between the face amount and the discount is called the carrying value. So the carrying value and the discounted bond will continue to go up until it hits the face value. My 20 years are up, I pay the bond off, I debit bonds payable, I credit cash. Okay? But you have to remember that the discount is not a gain, not a loss. It's a contra liability account at this point and will be amortized out over the life of the bond. What about a premium? And I'm not going to go through all the computations of the premium, but we saw earlier where we issued the bond for 100. Okay. So we would debit cash 1100. We're going to credit bonds payable, always at face, $1,000, and the difference is the premium. Okay, and that's sitting here. Premium. I have a $100 credit balance. Okay. That represents an addition, a reduction in the cost of borrowing. $100 over my 20-year life. And I will amortize that $5 per year. So what I'm going to do then is I would debit interest expense, X for expense, credit cash, 80. And now my next one is I debit the premium, $5, and I credit interest expense, $5, because remember the premium represents a reduction in the cost of our borrowing. So when I look at my interest expense, I started out with 80 over here, and then I got a $5 over here. So I would end up with a $75 expense at the end of the year. All right. Same as, and now the premium gets added to the bond to arrive at the carrying value. So when I issue it, it would be bonds payable 1,000 plus unamortized premium, carrying value 1,100. What's going to happen is that carrying value is going to come down until it reaches 1,000. At the end of the period, if we've done everything correctly and amortized it correctly, we will spread that premium out over the life of the bond, and our carrying value will be exactly equal to the face amount, $1,000. Pay it off, debit bonds payable, 1,000, credit cash, 1,000. Okay. So that's how discounts and premiums work. A discount is an additional cost of borrowing. A premium is a reduction in our cost of borrowing, because you're giving me $1,100, I only have to give you $1,000 back. That $100 is a savings in borrowing to me, the issuing corporation, when I say me. Carrying value is the face amount minus the unamortized discount. I say unamortized because that account, it's a real account, it carries forward every year, and it's going to keep dropping as we amortize it. Or plus the unamortized premium, and again, that's a real account, and gets carried forward every year, but again, it'll be reduced as we amortize that over the life of the bond. Okay. All right, I think I covered what I wanted to cover in this basic thing about bonds payable and the discount and premiums. Again, if I was, we did a very simple, very simple example here. We did not use any present value computations, time value of money. If we were to do this, we would find out that we would do things a little differently. We'd use a stream of payments discounted back to present value. So I would take the present value of the bond, which is $1,000, okay? But I'm going to get that in 20 years from now, okay? So I'm going to get that in 20 years, so I would bring that back to its present value. And I'm also going to get a stream of payments. I'm going to get $80 a year, okay? An annuity, $80 every year for the next 20 years in our example. I bring that back to its present value. Okay, and that's going to be my issue price. Present value of that bond being paid to me in 20 years from now, and present value of the $80 annuity, $80 a year. What rate am I going to use? I'm going to use the market rate of interest. What we did, I said when interest rates go up or down, we're talking about the market dictating how much interest they want. And so everything's going to work out in the end. But how do we get to that, 10%, that 7.27%, whatever that number was? It's actually going to be done through present value, and we're going to use that rate, either 10% or 7%, to make our computation for how much it's going to be issued for. All right, I'm going to leave the basic definitions up to you, as long as you know face value and stated rate of interest and market rate of interest. You'll be able to make your computations here in the discount and premiums of the bond payable. So I thank you very much for putting up with bonds payable for whatever few minutes we've been here doing it, and we'll see you in the next video.